Everyone, and we are going to get started on time, probably a minute later, but this is the final episode of a series of 4 webinars that Ryan has been presenting, and I think they were excellent, and I'm looking forward for the fourth one where he's going to put a lot of the different pieces of the puzzle together. So we appreciate your time and insight, Ryan, and anybody who's attending or is going to be viewing this recorded webinar on YouTube. Feel free to reach out to us with any questions and we will be happy to assist you. So Ryan, please take it over.
Awesome. Thanks again, Elon. I mean, I'll be honest, this has been a lot of fun for me. This is kind of a new thing that I haven't really done before, where it's actually a series of these webinars that are all kind of connected and follow sort of a chronological order and then come to a finale. So in a lot of these webinars we talked about, I mean, let's go back to the first one weeks ago. It was Intro to Futures. Then we talked about, okay, now you know about futures contracts. Now what do you do? And that's where we got into fundamental and technical analysis. So that's deciding your bias in the market and determining where you can get in and out of the market and different places you can utilize stops and different ways to enter and exit the market. The next step is options. And we talked about using spreads, trading with options, all the different ways that you can actually trade some of these products once you've identified those levels. The part that we're going to wrap this up with is going to be the mindset. And it's going to be how to keep the process that you've learned, that you've built in check. Now, this one's going to be, shorter than some of the other ones, nice, short, and sweet, but it's going to pack a punch because I'm going to talk about a lot of the different things we talked about and how it all kind of comes down to your mindset. And it comes down to how you manage your risk. It comes down to making a plan, sticking to it, adjusting the plan, and going from there. And it's the constant evolution. If there was a perfect trading scenario out there, everybody on earth would use it and we all be on a beach having a great time. The reality is you have to find something that you're interested in, learn how to try to manipulate it to the best you can, and always be refining that product. Always be refining your process. It's a never-ending education cycle, and it's something that you can continue to get better and better and better and better at. So that's what I'm going to talk about today. I'm going to talk about some of the pillars of how to, at the very least, try to be successful in the markets. And again, just a disclaimer, none of this is actual trading advice for product-specific things, anything like that. All of this is meant to do is to try and help put you in the right mindset to go out and execute. So very, very excited to kind of wrap this up, as we are looking to wrap up the year. And, I'm very excited heading into next year for, the different ways that, Elon and myself can work to build off this and use this as kind of a foundation as we can go on and continue to try and drive the education home and drive home the process to individual traders. So again, thanks, Elon. I'm excited to get going here. But essentially what we're going to talk about today is, the trader's mindset for consistency. And there's a lot of things that go into that. I think when you look at a trader, I think one of the strong ways to tell if somebody is good at what they do is longevity. And that goes in any profession. You look at somebody that's been, a professional athlete for, years and years and years. You look at somebody that's been in accounting for, 20, 30 plus years, or finance. That shows that they are not only good at what they do, but they've continued to get better. I think when you think about trading, it has to be the same, in the same light.
I will interject and say, look at Canon Trading, been here since 1988, so that's going to be 40 years in about 3 years. Yep. Sorry, Ryan.
You took the words right out of my mouth. I was going to talk about Canon, looking at the CME exchange as well. It's been around 180 years.
Yes.
So all of these, things that are there, it shows the growth, the ability to adapt and the flexibility, not only of the firms, but, the people that work there. So it's something that I wanted everyone to keep in mind as we get going. But let's jump right into it here. So thinking about discipline. So this is kind of the core challenge when it comes to trading, whether you're, in a position that's going in your favor and you don't know whether to take your profit or let it keep going, whether you're in a losing position and you're trying to decide, hey, do I add a few more here? Do I just cut the position overall? What do I actually do here? So that's kind of what this comes down to. So what we're trying to talk about is from reactive trading, going from just reacting to the market to using a process that is repeatable, not dependent on market outcomes. The market's going to go against you in trades. It's going to happen. Anybody that's been trading any amount of time knows that you're going to put on a trade that's going to go immediately against you. And that's okay. That's part of what we're doing here. But I want to talk about reactive trading. We hear this a lot. You'll see videos, you'll see people on TV talking about how do you trade through events? How do you trade through, yesterday with the Fed meeting? How do you trade through earnings? Whatever it might be. That a lot of the times that's considered reactive trading. And there's a couple problems right off the bat with simply reactive trading. One is impulsive decisions driven by fear or greed. I'm sure a lot of people have been in positions before where you've seen a market rip one way or rip the other way and then come right back to where it was. And a lot of the times you'll get that FOMO, the fear of missing out, or you'll get the fear or the greed about your position. What you have to remember is your core disciplines and your purpose when you entered the trade. Inconsistent results, difficult to analyze what worked or what didn't. Again, this comes back to a process. If you have a set process and a plan before you enter a trade on entry and exit, you can go back after a month of doing that and analyze the trades and have some benchmark to analyze it against. If you're just off the whim reacting to trades, it's hard to tell what worked for you and what didn't. So it's very important to think about that as well. And then again, high emotional states leading to burnout and costly errors. We've talked about this in all, I believe, of these webinars that we've done is we want to try and hit consistent singles rather than hit the grand slam 1 out of 20 times. Being consistent is going to keep you in the market longer, potentially. It could help minimize some of the overall losses that you could have if you are looking to hit singles and you're managing your risk properly. Going for the big swinging trade could wash you out and then you can't live to fight another day. What we see as a good solution to this is treating it like a business. If you think about a futures trading account, it is like a small business in many ways. And a lot of small businesses fail simply because they're not managed properly. We need a repeatable process to generate predictable results. Our focus today is going to be on basically 3 pillars of disciplined trading. Those 3 are going to be strategize, plan, and execute. Starting with strategize, that's going to be defining your edge, defining your risk. Then we're going to jump into plan, creating a daily playbook, understanding your entry and exits before each trade. And then it's execute. Then it's understanding you have a plan, trusting your plan, and being consistent and keeping yourself accountable. So pillar 1, defining your edge. So, what really is defining your edge? That could be a lot of different things. But one right off the bat is identifying the inefficiency. So what predictable behavior or market condition are you exploiting? Is it a seasonal trade? Is it volatility normalizing? Is it imbalances in supply and demand? Is it a specific market that you believe you have an edge in? If you've been working on farms your whole life, you might want to look at some of those products because you have inherent knowledge of how these markets work. If you're, thinking about different businesses, different sides of the world, you can come in wherever you like. Market focus. So what specific instruments? Like I mentioned, picking your market. But if it's spreads, if it's just simply corn, if you're going to be somebody that is day trading, if you're going to be somebody that's holding positions overnight for a couple weeks, maybe you're very, very long term. And, the day-to-day, technical fundamental analysis might not be for you. But you have to figure out what you want to do and in what market you want to do it. If you believe you can be successful trading spreads in crude oil, fantastic. Go for it. If you think that you're just going to simply speculate on corn futures because you believe you understand seasonality and you believe you can somewhat understand how the supply and demand dynamics are going to play out over the next year, go ahead and give it a shot. Establish strict risk parameters. So along with defining your edge, you have to understand, where your risk parameters stand. How much money are you planning on risking per trade? Is that $100? Is that 2% of your overall account? Is it 5%? And then never trade above that. Never do it. Even if you think, hey, this is a slam dunk trade. I've been, on a winning streak. My last 3 trades have made money. I'm going to scale up a little bit. Stick to your process. Over the long term, it's going to be more beneficial for you. Daily and weekly loss limits. Define a maximum drawdown threshold. If you're trading for a day and all of a sudden a position goes way against you and you say, hey, my daily drawdown limit is, $500. If I lose $500, I'm shutting my computer. I'll come back tomorrow, recharged, refreshed, knowing that I'm here another day and I'm not fighting from behind. What that can do is it can cause you to maybe scale up and lever up on some positions, which can add even more risk overall to your portfolio. And that goes across the board for your week, your month, your year, all of this. And that goes for the upside as well. If you have an upside target and you hit the upside target, bang, you can shut your computer and be happy, come back the next day, and it's a fresh day and you can reset yourself, recharge, and be ready to go. Risk reward ratio, understanding your entry and exits before every trade you put on. Now, this has been a common theme. I think I've mentioned it in every webinar we've done, but it's easy to get emotional about a trade when you don't think about how you're going to get out of it before you enter. If you jump into a market and the market just takes off in your direction and you're thinking, wow, look at me, I'm the greatest. This is a great trade. What do I do now? Do I add positions? Do I let this go? Do I completely cut it? That shouldn't be a decision that you're making in real time. That should be a decision that you have predetermined. And that decision can be one of many things. Like I mentioned, it could be maybe you're trading some micro contracts and you want to get rid of 2 of them and leave 1 of them on, just in case the market continues to go your way, but you've locked in some of the gains. On the inverse of that, if the market's going against you, maybe you start trimming the position a little bit until a certain level where you know you're going to be getting completely out of it. It's very, very important to do this. Like I mentioned, it's going to help eliminate some of the thoughts you're going to have as you're looking at a trade, if it goes for you or if it goes against you. And it can really, that can really strain on a trader. If you're watching your P&L just go on up and down all day and all night and you don't really know what to do, that'll cause you strain. If you can go, close your computer at the end of the day and know, hey, I might have some trades on overnight, but I know exactly where my entry and exits are going to be. I have my risk laid out. I can sleep at night. I can go and not be thinking about this 24/7. It'll really help, not just with your P&L potentially, it's going to help with your mindset as you come in each day. As we go from there, we go into pillar 2. And this is more of a personal thing for me, but I've found that a lot of traders I've worked with and talked to, they do this. And it's something I picked up early on in my career that has benefited me. And although I'm not allowed to trade futures anymore, working for the exchange, I still track them every day. And I still do this. I still have a daily playbook where I write down what markets do, what economic reports came out, just so I can go back and reference. I mean, I have composition notebooks going back to, Q3 of 2020, where I can go back and look at them and say, oh, well, when this happened, this market went up, this market went down. And it's very, very cool to see, not just for that reason, but I can understand my mindset back then, how I thought about a market, and I can compare it to how I feel now. And I can really, really see not only the difference, but the growth and how I analyze different markets. But have a pre-market routine. So having a macro analysis. So thinking about what's going to happen for that specific day. Reviewing economic calendars for high impact news that can affect your instrument that you're trading. So for example, if you're trading crude oil and there's going to be an EIA report, that's very important for you to know if you're going to be active in crude oil. The Fed meeting that we saw yesterday, that affects a lot of markets. That affects FX, that affects interest rates, equity indices, the precious metals. You're seeing that effect kind of across the board, and it can add volatility to really any of those markets. So understanding what are the things within my control, outside of a disaster like a tsunami or something like that that might just happen. What are things that are going to be released that are going to affect the markets I'm trading? Jumping into technical mapping, identifying your key support and resistance levels on different time frames. So if you're jumping in saying, okay, I want to go back and look at my daily chart I've been looking at for gold, for example, or for silver. It's hard not to talk about silver today with the explosion we're seeing in silver futures up over 64. But thinking about, okay, I'm in today. What are some levels that if say silver hit this level, I am interested in buying or selling at that level? Having that mapped out in the morning or before you get started with your trading day will help you not only in a mental clarity type of way, but it will help you in the fact that you don't have to be just stuck glued staring at your screen all day long. You can be active and you could be watching the markets, but hey, if this market hits this level, maybe you have an order there to buy or sell. Maybe you have an alert that's going to alert you that a key level has been hit in the markets you're watching. And then set the bias. Determine your expected scenarios for the day. Best case, medium case, worst case. And it's so important to do, I believe, all three. If nothing happens in the market, if, it's kind of a dull day and I buy this or I sell this, what does that mean for me? What's the best case scenario for me today? Say I nail the trade, I pick the exact right level, it goes, that's best case scenario. Worst case scenario, I believe, might be the most important, because although you want to map out what your best day could be, you need to know what the worst case scenario for your trades could be. It's essential, because you want to be able to live to fight another day. You want to be able to know, hey, worst case scenario, I might lose some money on this trade, but it's not going to wipe out my whole portfolio as long as I've managed my risk properly. And I can come back tomorrow with a fresh mindset and be able to say, hey, yesterday wasn't a good day. Not every day is a great day in these markets. I'm here today and we're going to reset and we're going to try and go back through our plan again today. And then you have to think about your trade checklist and position sizing. So entry and exit rules, as we mentioned, defining precise criteria for entry. For example, wait for a 15-minute close above your resistance point. Maybe you're waiting for the 200-day moving average to be touched by a market, then you're going to jump in and buy or sell it. Stop loss placement. Understanding, again, are you going to risk, if it's a dollar amount, if it's $5, if it's 100, if it's 500, is it a percentage that you're willing to risk on the trade? If you're going to risk 1%, 2, 5, 10% on a trade. And then calculating size. Size is very, very important, and it's something that I get a lot of questions about. How do I know what size to use? My view on this may be biased working in education for trading, but I always say, if you're not sure, do the smaller size. One of two reasons. You're still going to be able to analyze how well or how poor a trade is, regardless of the size of the trade. If you're correct in the trade, it's still a good trade. And then if you can, strum together a few good trades in a row, and then you have a little bit more capital, then you can think about doing different sizes, maybe just doing a few more contracts. But I always say, when you're trading, it's not necessarily, the P&L is what, the ultimate goal is, to raise that P&L. But you want to refine your skills. You want to refine that process to the point where you could say, hey, I'm comfortable with my process enough to the point where adding more size does work for me here. So pillar 2, really creating that playbook, is all about coming in whenever you're starting your trading day, having a pre-market routine, and going through your trade checklist. What markets you're looking at for the day, what size of contracts are you looking at, if it's going to be full size, if it's going to be E-minis, if it's going to be micros, even smaller contracts than that. Understand what direction you're looking for and how much you're willing to risk. Pillar 3 is, you take everything you learned from pillar 1 and pillar 2, and this is where you need to just go ahead and you need to execute, and you need to trust yourself. And that comes with consistency and control. So basically, adherence, not perfection. So what we want to do here is, nobody's going to have a perfect trading account. If they do, please call me. I'd love to chat with you. I'd love to see what trades you're doing. But when you're thinking about your trading, a couple things right away. Be patient, don't second guess, and trade as a unit. So when I think about that, I'm thinking of be patient. What you don't want to do, and a lot of times we see this with new, young early traders, is they might learn a couple technical indicators, and that's all they're looking for. And if you look hard enough at a chart, you're going to start to see technical indicators that you know. And I think everybody's at fault for this, but head and shoulders patterns might look, a little bit distorted, but if you look long enough, you might seem perfect to you. So be patient. Wait for the levels that you're looking for. Don't get emotional about, oh, I think I might miss the trade here today. It's okay. An important thing I learned early on in my career is, sometimes the best trade is no trade at all. Even if, you were going to move a level, a couple ticks one way or the other, again, that goes against your process, and it's hard to measure your success if you don't have a process backbone for it. Not second guessing comes right along with it. Is I'm sticking to my process, understanding, you might say, hey, I'm going to try this process out for 3 weeks. I'm going to try this process out for 2 months. Stick to it. Try. And because you really want to be able to not second guess yourself. It gives you, clarity, gives you the ability to be able to sleep at night knowing that you're protected based on your process. and execute both the entry and define stop target as part of a single action. So trading as a unit. So really understanding how this all comes together. And then one of the most important parts that really gets missed by so many people is the post-trade session. And this is the feedback loop. So this comes in with your trading journal. My composition notebook, the left-hand side of it is pre-trade, what happened during the day, and then the right-hand side is going to be my post-trade. What happened after the close? Was there earnings? What happened? What did I see? What was I right about? What was I completely wrong about? So being able to have that trading journal showing all of the trades that you made, you could do this on Excel as well. There's very good ways that you can automate this, but being able to, log the trades, being able to see where you got in, where you got out, and the reasoning, maybe why. Maybe it was a technical level hit. Maybe there was a big reactive trade that you were trying to follow. Reviewing the process at the end of the week, at the end of the month, at the end of their year is the time where you need to do some reflection. And each one of those is going to be different because at the end of a week, you might have a great week, you might have a bad week, whatever it may be. But you can understand if you're trading within your process, if you're following things the way you want to do it, then you can move on. At the end of the month, that's a little bit different. You can take some time at the end of the month and say, okay, what actually is going on with my process? How did it work? Did my P&L go up? Did it go down? How did I feel at the end of my trading days? Was I feeling anxious? Was I feeling very, very good about how I was putting on my positions and layering my risk? All of this. And at the end of the year, it's okay, how did this all go? Is which process that I tried out this year work the best? How can I try and refine it from things that I found throughout other processes, whatever that may be? So having that review process, it's a way of self-reflection. And this goes not just through trading, but you can utilize this across your whole life. But for trading specifically, it can really benefit you, and it can really, really take everything that you've done and everything that you've learned and kind of bring it together. And that can just fully, fully refine your skills. So just thinking generally about this, conclusion and next steps. So it's all about controlling your process and not controlling the outcome. You might build out a process that does not work. I'm sure anyone that's traded for, any sort of, period of time that's about over a year, they're going to have different processes that did not work. You might have said, I'm going to, do this strategy where I'm buying this at this level hits, and then I'm going to wait. Say it doesn't work. As long as you followed your process and you can move on from there, that's a good thing. Sustained success in futures trading comes down to converting your strategy into a reliable, unemotional process. And I know I'm harping on this, but it really is true. So thinking about the pillars again, those three big pillars that I really want to emphasize are strategize, plan, and execute in that order. So when we're strategizing, we're defining our edge and we're setting our risks up for the day. Planning, creating that playbook going, hey, yesterday, X, Y, and Z happened. Now this morning, the market is acting this way. And here are some of the things that I'm looking at. Here are three of the markets I'm actually planning on trading today, assuming that my levels are going to get hit. And again, just going through that process, it's going to make you feel a lot less overwhelmed when you jump in and you're looking at 5 different charts or 3 different screens and all this data is flowing in. You can know exactly what you're looking for and not be overwhelmed. And then the last one is execute, as I mentioned. Being consistent is the focus here, and documenting trades. I mean, I can't tell you the amount of times I've gone back to where the Fed was in a similar position, or maybe the Fed was in an opposite position, and I want to see how I felt about a certain market while the Fed maintained that position. If it was a cutting rates environment, if rates were going higher in that environment, how was gold and silver reacting? How was the S&P reacting? So really just documenting your trades, being able to go back, being able to understand exactly what you did, how you did it, and why. The why is really, really the kicker here, because if you can understand why you did something in the past and then realizing how it worked or how it didn't work, you can just take that and you can completely refine it. And that is really the goal here. If I could draw up a perfect scenario for a trader, it's, they get up in the morning, they take a look at the markets, they look at their notebook and say, okay, I'm looking at X, Y, and Z markets today. I'm looking for these different levels to hit. If these levels hit, this is my plan to enter. along with my exit strategy on either side of the trade. And at the end of the day, you can go through and say, okay, maybe all the positions went great. Maybe they all went terrible. Maybe you're holding them overnight, whatever it may be, but you can document how it went. It will just continue over a period of time to make you sharper. And you won't even necessarily notice it. But if you just think about your mindset a year later of doing this process, which again, I want to emphasize that this does not take very long. After about a week of doing this, you're going to have a good idea of how this process works for you and how you can kind of go in and out and how you can set up your day, how you can monitor your positions, how you can set up what you plan to do for the day, week, month, year. So, kind of thinking about everything that we have talked about. We talked about it all. I mean, we talked about why you should look at futures trading. We talked about ways, once you understand futures, ways to start analyzing them. Now that you've analyzed them, how do you buy or sell them in a unique way other than just buying or selling futures, thinking about spreads, thinking about options. And then today I gave you the playbook, basically how to get started, start looking at markets, start thinking about different products you might be interested in, take that information and start creating a playbook. So I think that there is, a ton of different things that we still could explore. And I'm excited to do that as we head into next year. I think that this has been a good foundation of ways we can maybe go a little bit deeper onto different asset classes potentially next year, or, very specific trading technical indicators, or, different types of specific spreads you could trade. So I'm pretty excited for that. But for here, I'm happy to answer any questions anybody might have. Again, I want to thank Elon and thank Cannon for helping us put this together. I think that it went really, really well. I've really appreciated the participation, and yeah, like I said, happy to answer any questions anybody might have.
Thank you, Ryan. I personally enjoyed it. I think some of the insight and methods and the thinking that you shared are really helpful and can assist newcomers and traders who've been trading for years to try and improve their trading. And like Ryan said, treat it as a business. You cannot even think that you can come in, open your desk, open your computer, log into your trading platform, and just out of the blue decide to buy and sell. If you're going to do that, that's pure gambling, and that's okay if that's what you want to do. But if you want to give yourself somewhat of an edge in this very hard, tough business called futures trading, all the steps that Ryan shared, in my opinion, are a must. Keeping notes is huge. Planning for the trading day ahead is huge. And evaluating what you're doing on an ongoing basis. Is it working or is it not working? And there's a lot more. And I'm looking forward for next year to have some sessions where Ryan hopefully can share some indicators or trade setups that he like, or maybe certain spreads that he like during certain times and why, and really dive a little bit deeper into the why we buying, why we selling, how to do this and how to do that. But until then, thank you very much, Ryan, and thank you, CME Group. And thank you everybody that joined, and thank you anybody that is watching it over the recorded webinar on YouTube. Feel free to visit our website, canontrading.com. Our biggest asset is our brokers and the knowledge that we possess here as a group, on top of the many years that we've been in business, and we would love to try and help you. So happy holidays, everyone. Thank you, Ryan. And we're going to call it a day, call it actually a year as far as our joint webinars with the CME Group.
Yeah, no, thanks again so much, Elon. Really looking forward to next year. I think there's some really cool things we can explore. So very excited to get that going.
Agree. So looking forward for a great 2026, and in between, enjoy the end of 2025. And thanks again, and good trading, everyone. Bye-bye.
Thank you. Have a good one.
Bye.